Hello, today is the 30th of March, 2022, excuse me, 23. Try to give myself a year younger. We are here, we're live. This is the Debt Free Life piece that we do. We do this typically twice a month, sometimes three times, but we try for twice a month. These are always on Thursday evenings at 5:30 p.m. Eastern. We always use the same link, so feel free to come back anytime you want. If you don't know whether this is a week or not in which we're doing one of these programs, reach out, talk to us, ask a question. We'll be happy to answer. So let's go ahead and get started. So this is the Debt Free Life program from Symmetry Financial Group. This is not a get-rich-quick scheme. This is not debt consolidation. This is not debt negotiation. We're not talking about doing home equity line of credits here. We're not talking about refinancing, none of that stuff. What this is a novel way, and I say novel, not that it's new, but it's been around for a very, very long time, over 100 years. But this is a way that wealthy people typically have been using to shelter money, because in a debt-free life program, if it's structured correctly, the money that you put in here and the money that you derive from the program is not taxable. The IRS cannot touch it, tax it, or see it. So let's move on. All right. So typically when we talk about these programs, when we're looking at debt, we're always saying two primary things. Number one, are you 100% certain you're going to have a great retirement? And most people, unless they're a pompous financial advisor, are not able to answer that question. Yes, most people do have some doubt. And the other question we ask is, if we could show you a way to get out of debt in 9 years or less, would you be interested? And actually, having done hundreds, if not thousands of these programs, what we actually are seeing now is that it's not 7 to 9 years. What really is happening is we're getting out of debt 15 to 27 years early. We did one the other day where the individual had 30 years of time before they were going to get out of debt because they just refinanced their mortgage. In the plan that we were able to design for them, they were out of debt 2.3 years. So it's different for each person, and that's why each one of these things requires a licensed, trained, certified individual to do these, because there's a lot of math that has to go into this, and as far as the planning is concerned, and we want to make sure that the program that we put in force or put in place with our clients is one that's going to do and act exactly as we project. Okay, so let's move on. So if you're like most Americans, this is where you are. The average American spends about 23% of their dollar on living. They spend about 40 cents of their dollar on taxes. They spend about 34% or 34 cents of every dollar on actually paying interest. And then finally, that little tiny sliver at the top of your screen, that's 3%. That's what's left to save for retirement. So let's put that in perspective. That question we asked just a minute ago, are you 100% sure that you're going to have a successful retirement? There isn't anybody out there who's saving 3% of their income that should be confident that they're going to have a successful retirement. Because if you're going to go from 100% of your income to living on what you've been saving only 3% of your income, the math doesn't work. And unfortunately, we are put into the position where we need to start relying on Social Security, which they've already telegraphed is going to have a 24 or 25% reduction in what it pays out in about 10 years. And we're also, unfortunately, reliant on our three-legged retirement stool, a pension, a retirement program, and savings. Well, most private companies have done away with their pensions. So the one of the main legs of our standard retirement plan is gone. So we're trying to create a new leg. We're trying to replace that leg, and that's what these DFL programs can do. All right. That metric that you see right there is 74 cents of every dollar you earn goes to pay for taxes and interest. It's rough, and that certainly is not what the founding fathers of our country had envisioned when they created this country. Anybody remember well, I don't remember it, but I certainly read about it when I was in grade school. The Boston Tea Party, all about taxes, right? Being overtaxed, right? So let's do something about that. The problem that we have with retirement is not that we don't make enough money. The average American makes $2 million. Again, that slide is 4 years old. That number is probably maybe a little bit up. Maybe 22.1 million now on an average lifetime. It's still plenty of money, But the problem is that most Americans aren't taught how to spend money. We certainly aren't taught how to save money. And when it comes to getting out of debt, the people teaching us how to get out of debt, the banks, it's in their best interest for us not to get out of debt. So where we see here, this is that $60,000 you see on your screen as far as savings is concerned. That number represents 3% of $2 million. That's where on that previous slide where we talked about saving only 3% of your income, that's actually what most Americans that are retiring have. They're reliant on a pension, which probably doesn't exist or isn't where they think it's going to be. They're reliant on Social Security. And unfortunately, they're relying on a $60,000 saved amount of money, which doesn't go long if you're accustomed to making even $60,000 a year, which is not a lot at retirement age. It doesn't work. The math doesn't work. All right. So what can we do? Well, when you talk to people who are in the debt consolidation, credit counseling, debt negotiation industries, what they're going to tell you are the things that you see on your screen. They're going to tell you to go get a second job, work harder. They're going to tell you to spend less money. If you could spend less money, you probably would be. They're going to tell you to save more. If you could save more money, you'd probably already be doing that. Refinance. Refinancing doesn't really work. All that means is that I'm taking this amount of debt and I'm replacing it with exactly the same amount of debt, maybe at a lower interest rate. Okay. Consolidate. That doesn't really work. I'm taking a bunch of small debts that in and of themselves each are easy to pay off, and I'm putting it into one large lump, which by itself is much more difficult to pay off. So consolidation doesn't work, certainly all the time. And then finally, that last one down there is a debt snowball. There's a lot of chatter out there on TikTok, other social media platforms about debt snowballs. You've got some folks out there that call something a debt snowball that isn't really a debt snowball. I did this exercise with one of my clients the other night. That client had a total of 8 debts or 9 debts maybe. And when I looked at the different order that they could actually pay off their debts, there were over 5,000 different combinations. Debt A, then B, then C. Debt A, then C, then B. Debt B, then C, then A. Debt B, then A, then B, and so on. There's over 5,000 combinations. Only one of them is the best combination. And when we're looking at this stuff here, we're looking at what is that one best combination? What's that one that's going to give me the most rapid time frame that I'm going to pay off my debt, and more importantly, the most amount of money at retirement? And there's 4 primary variables we're going to look at. We'll show that in just a few minutes. But the point is that it's really, really difficult to discern what the best order to eliminate debt is unless you're taking into consideration those 4 variables. And unless you're only dealing with 2 or maybe 3 different debts, it's not something the human brain can easily comprehend unless you are a mathematics savant, which most people are not. So that debt snowball piece that you see in here, what we use is a true debt snowball, not a debt stack, not a debt avalanche, a debt snowball. The debt snowball, a true debt snowball, is the fastest way to eliminate any debt or any collection of debt, leaving you with the most amount of money at a specific period in time. All right, let's move on. So obviously there's a better way. That's why you're here on this call. This is about debt-free life, right? So what we want to do with a debt-free life program or an infinite bank, they're the same thing, is we want to move you from the left side of your screen to the right side of your screen. We want to reduce the amount of money you're paying in taxes. That reduction from a 40% of each dollar being reduced down to 30% of each dollar. If you do the fast math, that's 10%, but it's not. That's actually a 25% reduction in taxes, right? Let that sink in for a second. If I change how much money you're spending every month, this is that lifestyle discussion. I know that if I create one of these programs that's going to cause you to have to spend more money each month, you are likely to stick with that program for about 6 months. And then you are likely to cancel that program. So that doesn't do anybody any good. Certainly doesn't get you out of debt. So we know that we can't do something where your lifestyle, where your cash flow is reduced. We actually have to increase it, which is going to give you a greater likelihood of sticking with the program. If I can reduce the amount of taxes that you pay from the 34%, which is the average right now, down to 22%, that's actually, get this, a 43% reduction in the amount of taxes I'm paying over time. And that is huge, right? We all pay taxes. One way or another, we all pay taxes. But if I could say, hey, listen for just a second, I'm going to show you a way to pay 43% less tax. And that's all we're going to do is pay 43% less tax. Would you want to do that? Of course you would. And that's just one of the benefits of these programs. And then finally, that's the retirement discussion. Saving 3% of my income over a period of time where I've got $60,000. Well, what if I could increase that to 15%? Notice nowhere in these calculations did we say we're going to earn more money. Nowhere. We're not telling you, these programs are not designed for you to go out and get a new job, get a bigger job, get a raise. None of this is in the equation. As a matter of fact, when we structure these programs, we're assuming you're never going to get a raise. Okay. So when you get a raise, it really is a raise. You're going to have an increase in cash flow, right? Okay. So that change from 3% to 15% is actually a 500% increase in what you're going to have set aside for retirement. It's a heck of a lot easier to retire with $300,000 in the bank earning interest for you versus $60,000. Okay. All right, let's keep going. So what we do and how we do it, we reduce the amount of interest you pay over time. We eliminate all your debt in 9 years or less, really 15 to 27 years early, because I know, just like you do, if you can retire without any debt, then your life is much easier. And more importantly, if I can get you retired sooner and you're still working, that gives you more time to build up that nest egg for you to have a nice, comfortable retirement. We're going to reduce your taxes. We're going to reduce interest. We're going to improve your cash flow. Again, because I know that if we put something in place for you where it costs you more money per month, you're not likely to stick with it. And then finally, we're going to get you retired with a tax favored income. Okay. It might be tax deferred depending on how you touch it and when. It might be tax favored in the form of never paying taxes, which in my opinion is the most and highest and best tax favored type of income. But that's what these programs are going to do for you. Okay. There's a lot of chatter out there about different types of programs. You got people that are out there advertising HELOC versions of this, home equity line of credit. Home equity line of credits fail because they are adjustable rate loans. You have no idea what the interest rate is going to be in 3 years. You know that you've got an interest-only loan for 3 years. So if you pay your interest-only loan for 3 years, your cash flow might be increased in the short term, but ultimately it's going to be a very onerous process for you to get out of debt using a HELOC. These programs are failing left and right, unfortunately, right now, because those interest rates are starting to adjust upwards. There are programs out there that use software that you have to pay for that shows you how to move money from one account to another account in a rapid fashion. Those programs are okay, but they only work for people with large sums of money where you can really take advantage of getting a high interest rate move. All right. So if you're like most Americans, you don't have $50,000 or $100,000 sitting around in cash. So that particular program doesn't work. And there's other 3 programs which are all based on life insurance. One's a whole life program, one's a participating whole life program, one's an IUL program. All 3 of those programs do this thing that you see on your screen right now. They all plan for the unexpected to some degree. And the unexpected would be, what happens if you and your spouse are trying to eliminate your debt and your spouse loses their job, or you lose your job, or even worse, one of you passes unexpectedly? That's what we're talking about here. The reason why a lot of these other programs that are out there that don't use a life insurance vehicle as the underlying bank, private bank, infinite bank, fail is because they don't plan for the unexpected. So here, the way we do it, we have a 20% buffer that's hidden. It's there, but it's hidden. And the idea is that if one of those emergencies, a true emergency happens, not the emergency that I need to go out and buy a new car, that's not really an emergency. The emergency that my brother-in-law just got diagnosed with XYZ and he's not going to be around long, they're not prepared, and I'm going to step in and I'm going to rescue that family's house and pay it off for them. That's the kind of emergency I'm talking about. Okay. So if you have a true emergency, the money's there for you. All right. All right. Let's go here. So we talked just a minute ago about a tax deferred or tax advantage or a tax favored retirement. So this is a great slide that talks about different methodologies that you can use to sock away retirement money, right? So you've got three options. You have a taxed option, a tax deferred option, or a tax-free option. In all three of these cases, the math that we did, it used the same initial investment of $10,000. It used it for the same period of time of 28 years. It used the same standard interest rate of 7%. Good luck finding something that grows at 7%, by the way, permanently. And then we used a standard tax rate of 25%. Good luck if you think you're going to be in a 25% tax rate when you retire. Doesn't matter though. We did all the same numbers for all three of these processes. So a taxed retirement program would be like saving money in a savings account. Okay, you're paying tax on it. It's growing very slowly. That's the number that you look at. That's looking at a 0.25% growth over time. Tax deferred, that would be using a 401k, a 403b, a qualified retirement account. And then finally, that tax-free account, that you could consider that to be a Roth, except for the Roth has limitations about when you can access it and it has loss potential. Or you can use the program that we're talking about, which is a participating whole life where there is zero loss potential and zero taxability if you access the money correctly. This, don't have any illusions. What this is, yes, we're talking about life insurance. However, we are using this as a financial instrument, financial tool. And all financial tools work in the same method if they're being used for the same thing, which is ultimately a debt elimination strategy and retirement strategy. So all these programs work the same way. Maximization phase, accumulation phase, distribution. What's maximization? Maximization phase is the part where we are ramping up how much money you're putting into the program faster and faster and faster because we're eliminating the debt service that you're paying. So as the money comes down that you're spending on debt management goes away, you're increasing the amount of money that you put into your private bank. That's all this is. It's the same amount of money. We're just changing the direction of where it goes. That's the maximization phase. When you finish the maximization phase, that means you have eliminated all debt and you are now putting in the most amount of money you're going to be putting in at a level process for a period of time. However long that period of time is however long you decide to be in the accumulation phase. Because at that point, you're no longer eliminating debt. All you're doing is taking bricks and building a wall. That's your retirement wall. Brick after brick after brick after brick until you're ready to retire. And when you're ready to retire, oh, by the way, you don't have to wait until you're 62, 65, 67, or 72 to retire. You can retire at 48 if you want to. Okay. You retire on your terms, not when the IRS says you can retire. Okay. When you reach that retirement age, whatever you self-define as your retirement age, then you have entered into the distribution phase. And that's when you start taking money out in a tax-exempt manner for as long as the money will last or as long as you planned for. These can be structured for permanent income. Okay. Just like you can take an annuity and annuitize it for permanent income, same thing is possible here. All right. Let's keep going. This is not new. Let me say that again. This is not new. This has been around for well over 100 years. John Rockefeller did the first one that I can find. J.C. Penney, Woolworth, J.P. Morgan Chase, all the wealthy families and super wealthy families from 1905 on have done these programs. And these are people that use them as a process of either management of debt or wealth accumulation. Walt Disney used this program to build Walt Disney World because he could not borrow enough money from the banks to do it. So he duplicated funds out of his participating whole life program and used that as a funding vehicle for Disney World. Doris Christopher did it with Pampered Chef. Ray Kroc did it for, I think it was 10 or 11 of the first McDonald's units. Same deal. Couldn't get the loans from the bank they needed, so he borrowed the money from himself. Warren Buffett does it to this day. Do you think there's any correlation between the wealthiest people in our country using this tool as a wealth management and wealth growth and really generational wealth creation tool? Of course there is. These people know something. We know something. And now hopefully you're learning and you know something. Okay. Harnessing the power of life insurance. We use life insurance for a very specific reason. And that is because life insurance is the only investment vehicle on the planet where you can have money and use it at the same time and still earn interest on that money while you're using it. It's the only one, folks. There's nothing else like it. Put money in a savings account. As soon as you take it out to use it, it's gone. Put money in the stock market. As soon as you take money out to use it, it's gone. Okay. So this is the only one. And all those bullets there are all true. This is about legacy creation as well as wealth transformation and wealth translation and generational wealth creation and debt elimination. It does all those things. So what I just said, all that list of stuff, you should be having an aha moment right now. This is a Swiss Army knife. This does everything. It can be used for anything. Anything is that you can imagine, you can use this program for. All right. So that's one of the things I like about it, is because you can get crazy with it. All right. So again, this is same stuff we've been talking about. Those people you see on the screen, those were some very, very early success stories that we had. Well, actually 4 or 5 years ago at this time. It's all true, although the numbers that I see over there, 84,000, 73, 100K, those are all light. Most of the people that I meet with these days have upwards of 300,000 or more debt. Some of the people in the higher end of the debt load that we're looking at are about 1.5 million, 2.5 million. So the amount of debt that you owe, and here's a beautiful thing about this program, the amount of debt that you have, this program will work for you. The amount you owe is not relevant. It may be relevant to you, but it's not relevant to the program. As long as you are someone and you're making debt service on the program will work, as long as it's structured correctly and as long as you follow the plan. So to do this, you have to understand how you spend money. Okay, so let's talk about that for a second. So right now you work your job. Maybe you're a 1099, maybe you're a W-2, W-4 employee. Maybe you're an author and you earn your money through royalties. I don't know. But right now you earn money, however you earn it. That money gets deposited into your checking account, your bank account. Your bank lends that money out every night over and over and over. And they make money with your money at the federal funds rate or higher. The reality is, and I've seen different numbers. I've seen 61 cents, I've seen 69 cents, and I've seen 74 cents of every dollar you put into the bank. That's what the bank earns with your money, somewhere between 61 and 74 cents. And how much do they pay you for the use of that money? They pay you zero. That is the very definition of arbitrage. And we're going to talk about that in just a minute too. Arbitrage means that you're able to borrow money at a lesser interest rate than you're able to use to make money with. So if I'm borrowing at 0% and I'm making 1.8%, then I'm making 1.8% arbitrage. Okay. So at the end, the bank uses your money. It actually uses your money about 7 times. It lends your money out 7 times, right? And then finally, you tell the bank, go ahead and pay my creditor. Send the money off to my car company. Pay my car off. And then your money has become their money. In this example, which is, by the way, how we are all taught to spend money. In this example, your gain is zero. The only entity that made any money here is your bank. And your bank made 70, we'll just call it 65% with whatever money you deposited into your account. Your bank made 65%, you made zero, and your money's gone. You spent your money exactly one time. Let's say it's $1,000. You spent $1,000 to pay off your car. You traded $1,000 of your cash for $1,000 of a vehicle, 1 for 1, no gain. Actually, in that case, you're losing money because you're traded your cash for a depreciating asset. Okay, so that is what we are taught to do. There's a better way. Here's the better way. Same money, same income, goes into the bank again. And this is where the game changes. We pay a life insurance company a premium for our whole life policy. There are other people out there that like to use an indexed universal life policy for this. For me personally, I don't like that unless they're very, very young. And the reason why is because the IULs, the growth on them is not level. There will be years where you'll have zero growth. And if I'm trying to use this for a debt elimination strategy, then my problem is I can't make an accurate plan because I don't know what the interest rate or what the growth is going to be 2 years from now or 3 years from now. I don't know if we're going to have another 19.4% loss in the market like we did last year, this year. I don't know. But I know that if I use a participating whole life policy, I'm going to get a guaranteed interest rate plus, in this case, a dividend as well. So I'm going to make that premium payment. So instead of my bank keeping my $1,000, all right, I'm just using 1,000 for fast math. It doesn't have to be $1,000. Instead of my bank using $1,000 and making money with it 7 times, I'm going to spend that $1,000 and send it up to my life insurance company. My life insurance company, when it receives that payment for my life insurance policy for my premium, they're going to split it up. They're going to split up into 3 parts. The first part is whole life. That is the life insurance policy. It is a whole life policy. They're also going to apply some of it to a term life rider, and they're going to apply most of it to what's called paid up additions. Let's talk about paid up additions for a second. Banks are required to keep an amount of assets on file so that they can back up whatever they're lending with an asset that they can say, yes, I've got $400,000 of assets over here, so I'm going to lend $400,000 of money over here, which is backed up by that $400,000 over here, right? That's how they back up their lending. Banks have 4 tiers of assets: tier 1, 2, 3, and 4. What's the difference? Risk. Okay, risk reward. So a tier 4 asset would be something like lending $2 million to a 22-year-old busboy to go open a brand new restaurant. Very risky, probably not going to happen, probably never going to see that money, and they're going to charge a massive amount of money for lending that. They're going to make a ton of money for a period of time, then they're going to go belly up. Okay, that is a tier 4 asset. Banks don't do a whole lot of those. A tier 1 asset, a lot of people would think, if you're thinking to yourself, what's a safe bet? What's a safe thing, right? Bonds, right? Anybody know what's happening to the bond market right now? It's going through the floor. Why? Because the Fed keeps raising interest rates. As the Fed raises interest rates, the bond market decreases, right? So is bonds a safe investment? Yes, as long as you don't need to know what the gain's going to be, or as long as you can count on a minimum amount of gain. Bonds can go to zero, folks. Okay. What about precious metals? Platinum, gold, silver. Great. However, what's the value going to be in a year, in 2 years, in 3 years? Has silver or gold ever gone down in value? Of course it has. It goes up and down, right? Hopefully it goes up more often than down, but it goes up and down. So is silver or gold or precious metals a good tier 1 investment? I would say yes. However, the banks don't like it because they don't know what it's going to be worth. So if they're lending money and they've got a balance sheet that they have to maintain, they want something that's got a permanent value. And guess what? Paid up additions, permanent value. What does that mean? Paid up additions means paid up additional life insurance. If I buy $1,000 of paid up additional life insurance, tomorrow it's worth $1,000. A month from now, it's worth $1,000. 10 years from now, it's worth $1,000. That means if I'm looking at my balance sheet and how much money I can lend out, that's a safe bet. It is always going to be worth $1,000. And if that person dies, it's worth $1,000, right? So that's the beauty of paid up additions. That's why banks, there's a thing called bank-owned life insurance, and every bank out there has some. Some banks, Wells Fargo, have billions. I think Wells Fargo has $19 billion. I think Bank of America has $24 billion of bank-owned life insurance on their books to support their lending activities, right? You think banks might know something? Well, guess what? It's not just banks that do this. Anybody ever heard of Heinz? Anybody ever heard of Nike? Yeah. All these companies do the same thing, except in that case, it's not bank-owned life insurance, it's company-owned life insurance. And they use that to pad their bottom line so that when their folks come back around and do their analysis every year, they can say, oh yeah, you got a lot of assets. There you go. All right. So that's that. So we use paid up additions. The money that you send in here, usually about somewhere between 60 and 70% of every payment you make is going to go to paid up additions. It's going to be worth what you pay. If you're paying $1,000, 70%, that means $700 goes to cash. Anybody ever try to take money out of their 401k after putting it in and you're not at retirement age? Can you do it? Yeah. What happens if you do it? You lose your rear. You're going to get a massive penalty. You're going to pay a lot of taxes, a lot of penalty taxes, right? In this case, the nice thing about these programs, and this is ding, 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 it's liquid, right? If I make that one payment for $1,000 and $700 go to cash, I can borrow my $700 tomorrow and go do something else with it again, over and over and over again. Okay. That's why we like these programs. That's why the wealthy like these programs. All right. So I've taken the money out of the bank. I've put it up into what is now my private bank, my debt-free life bank, my DFL, my infinite bank. They're all the same thing. And now I'm earning money with my money. I'm earning a guaranteed interest rate and I'm earning a dividend. Oh, by the way, the interest rate on loans from these programs also follows the Fed, kind of. It actually follows, doesn't matter. But the interest rate is creeping up. However, so is the dividend. So it's kind of a wash. The extra money that they put back into the program based on a dividend is being offset by the increased loan cost if you're taking loans. Okay. So don't stress out about that. It's not a massive deal. And it's all going to come out in the wash anyway. So then you say, but Scott, I've still got that car. I still want to pay that car off. Now my $1,000 is sitting up in my private bank. What do? Well, take a loan. Now, in this case, the loan goes back into my bank account. I tell my bank to pay my creditor. The creditor receives the money. That money becomes their money. What's my gain? Anybody? My gain is 100%. Why? Because I still have my money. My money's in my private DFL bank. I did not take my principal out. I did not take my money. I took a loan against my money. I put it back into my bank account. My bank got all excited because they say, okay, great. Here's another $1,000 forehand put in. We get to go ahead and lend this out 7 times. And I say, no, send it to my creditor, pay my creditor. My creditor receives $1,000. Do they care where the money came from? They do not. They just want to get paid. The only person in this scenario that loses or entity is my bank, because my bank doesn't get to make money every night with my money. I'm making money with every night with my money. And then, oh, by the way, after I'm using my money, guess what? I'm still making money with my money because I didn't take my money out. I'm still earning an interest rate. I'm still earning a dividend, right? Holy cow. You mean I can have my money and use it too? Yes, exactly. Okay, let's keep going. So at this point, I would normally do a discussion or a presentation about how these programs actually work and what we have seen in, actually, I'll just do it real quick. Everybody still see my screen? Say debt-free life bank at the top? Yep. All right, here we go. So this is a client that we put in place 2019. I spoke with this client about 4 months ago. They're actually ahead of schedule than what we actually saw. And the reason why they're ahead is because they saw the value and they actually started overfunding the thing even more than we presented. They were on track to be out of debt in 40 years. Why? Because the wife had a student loan because she was a doctoral student. Student loans are evil, people. And she was, of course, taking advantage of what student loans love you to do, which is put that loan in deferment. And unfortunately, they bit on that and thought that deferment meant that the amount of debt that they have wouldn't grow, and they were completely wrong. Okay, interest rate still happens. You're just not making any payments, right? That's why student loans are evil. So in this particular case, they were going to be in debt for 40 years. What we did for them is show them this screen. which blew them away. Why? Because they thought they were $585,000 in debt. And that's not the truth. Because once you calculate the interest, that's the true debt, 767, right? The good news for them is that they make good money. The better news for them is that the woman has graduated with her doctorate and she now teaches at William and Mary University. And instead of spending $40,000 a year on school, she's now making six figures. So their program is accelerated because she's had an increase in income. But the point is that that's where they were before. This is where they were on the day we started. And this is where they are now. Actually, they're accelerated. This was a 7.8 year program, and they're just at that point where they're year 4.42. If you see that over here on the left side, 53 months in, this is where they're just before this. They're actually accelerated. So they're getting ready to knock off that student loan. So we have changed the student loan, which was on a 40-year payoff, down to a 4.4-year payoff. And when you look at and consider the amount of interest that they're going to be saving over time and what that allows them to do as far as planning for retirement, it is a massive impact to their financial future, right? Not only that, we're going to pay off a house that they had 23 years left on the mortgage, which was a rental property, and they're going to pay off another house that they had 30 years left. We're going to pay that off in 7.75 years, right? Nope, we're going faster. So let's talk about that for a second. The gentleman that we wrote this on was 36 years old at the time. He said he wanted to retire at age 75. So we ran it to age 75 and then made zero payments, right? With this program, we allowed him to retire at 55, 20 years earlier than we was anticipating. Why can we do that? Because at age 55, he's got $1.5 million of cash in the program. This is without them spending any more money than they're spending right now. This is without them getting a raise, which they did. This is without them doing anything different other than spending money in a smarter way, a more efficient way, and having their cake and eating it too, having their money and using it too. Here's the money shot. Money shot is this. In 7.8 years, according to the original plan, they were going to be out of debt. They were going to save $70,000 in interest. That's pretty substantial. If you're walking down the street and you see $70,000 laying on the side of the road, after you look around to make sure it's real and you're not dreaming or on something, and you pick up that $70,000, you're going to be a happy guy or girl, right? Of course. So in this case, that $70,000 went straight to retirement, which is, in this case, a leveraged retirement because we're earning interest and a dividend. But more importantly, where they were going to be in 40 years is completely debt-free with assets of 2 completely paid off houses. That's where they were going to be. With this program, in 40 years, at age 76, they're going to be completely debt-free with 100% equity in 2 houses and $4.8 million liquid. Liquid, folks. Not to mention a massive $1.1 million, $1.2 million of death benefit that's fully paid up that they never have to pay for again. That's legacy. So these people with this program are doing 3 things at the same time. They're building a massive retirement, they're rapidly eliminating debt, and they're creating a legacy for their family for generations to come. That's the power of these programs. All right. One last thing. There's advanced technique that we teach. One's called mortgage chunking. So in this case, if we look at this screen, where in month 71, they're scheduled to pay off the rental property. And then in month 93, they're scheduled to pay off that at their primary residence. That length of time from month 71 to month 93 can be reduced simply by making regular payments that they take from the program and throwing it at their primary residence mortgage in forms of principal chunk payments. Okay. And what that means is 16% is the average of dependent. The shorter period of time, you can't do it as fast. Longer period of time, you actually can have up to a 22% decrease in time. So I just use 16% as the average. So in this case, 16% of 22 months, it's about 3 or 4 months. So simply by using the money that's in the program more efficiently, they can cut an additional 4 months off this schedule. Okay. So I'm going to be quiet for a minute. See, honey, I listened to you. I didn't say the word that you told me not to say. And we're going to open up for some questions. And then we're going to introduce Mark Creighton. We're going to pick his brain. Okay. Let's go back.
I have a quick.
Yeah, go ahead. Hey, Christine.
Hey, I got a quick question. That thing you just had up there that had like the dates of it's when they get paid off, right? That like up top, that last sheet you just showed with where you were showing like at the bottom it had the two mortgage payments.
Yes. Hold on.
Okay, the stuff up top, that's like it's like this. So all these up top where it says last payment date, so that's when they end, right? Am I understanding that right?
Date. So you talking about total payments, last payment date?
Yep.
That was the schedule for these folks. This schedule is fluid. Okay. And this is, remember I was telling you that there's so many different ways, so many different orders they could have paid this stuff off, but there's only one best way. This one, this had over 200,000 possible variations based on the number of debts. So this is the best order to pay this off, to get the debt eliminated as fast as possible to create the largest amount of wealth in the end.
Okay.
I
just want to make sure I was understanding why it was put in that order. Okay.
Yep. Yeah. So there's four factors. How much do you owe? What's the minimum payment? What's the interest rate? And what's the amount of cash it's going to create in the end for you to recycle? Those are the four variables that you have to compute. And I can't do it for more than 2 or 3 variables.
Okay.
All right.
Thank you for explaining that to me.
Sure. How are the banks and companies getting these policies, or just owned all their executives? So Martin. All right, Martin, I got a question for you, buddy. Are you still here?
Yeah, hit me with it.
I want to know how to pronounce your last name.
You haven't heard it on all the
I've heard people I think slaughter it. I just want to hear how to properly say it.
No, they're actually getting it pretty darn close, man. It's Pizamuka.
Is it Zamuka?
Pizamuka.
Pizamuka. Okay, very cool.
Yep.
All right. So your question is, how are the banks and companies getting these policies, or is it just owned all their executives? Do you mean for bank-owned life insurance?
Yeah, exactly.
Okay. So have you ever heard an advertisement on the radio that says, if you've got a life insurance policy worth $100,000 or more, don't cancel it. It's probably worth money and we'll pay you something for it. Okay. Those are called viatical settlement companies. And their job is to go out and find life insurance policies, especially paid up ones, and they'll pay people 10 cents, 20 cents on the dollar. And then they package them together in big groups, and then they sell the group to a bank. So that's how the
mortgage-backed securities with life insurance, kind of, sort of.
It could be that. Ultimately, it goes to the bottom line of what their general ledger has out. They're using this as a vehicle to secure what they're lending. All right. They can get as much cash as they want from the Fed anytime they want, but this is where they're procuring those life insurance policies from.
Cool. Hey, real quick, while we're still while you and I are chatting, if somebody didn't have debt and they just wanted to say roll their mortgage payments into one of these policies, and how does that work exactly?
All right, so that's a deeper question. What you just talked about, rolling mortgage payments into this, okay, that's a secondary funding strategy. There's a huge difference between primary funding and secondary funding, okay? And if you want to use this like a cash flow bank, okay, there's different math that has to go into it, okay?
Okay.
If you're just using this for wealth creation or wealth preservation or wealth transfer, and you don't have any debt, then it's just an infinite bank. They're all debt-free life programs are infinite banks, okay? All infinite banks are not debt-free life programs. They can be, potentially, okay? All right, let's see. Gus, if these savings vehicles are based in US dollars, what happens when the dollar collapses? Well, Gus, if the US dollar collapses, none of this makes any difference whatsoever. Your life insurance isn't worth anything, and you're probably looking at World War III, all right? So the US dollar collapsing is not something that's it's not a concern for me. It can't happen. Yeah, there you go. Donna M. Forehand. Got a question? Hand raised. Guns and ammo. There you go. Bridget, Mikhail.
Yeah, I have a question. So I know obviously once your DFL pays off your debt, like let's say this credit card won, you're taking that money and you're now putting that back into the policy. Do you have to continue to put that money into the policy forever?
Great question. Who owns the bank?
Sorry, say that again.
Who owns the private bank?
You
do. Yep. So do you want to force yourself to continue paying forever, or you want to give yourself a break?
Well, you can pay. I'm saying, do you have to continue paying that? Like,
right.
Let's just say your debt is $2,500 a month and your premium is $1,000. Okay.
Sure.
I don't know. I'm just.
So I know the question that you're asking. I was just trying to get you to say the answer. So,
well, I guess you don't have to, but how does that?
These are fluid. You can do whatever you want. If you follow the projection that our software shows, that means that you are repurposing. Remember, we're not spending any more money than we were spending before, right? We're spending the same. Okay. If you want to give yourself a break, give yourself a break. If you don't want to, don't. If you want to accelerate, then pay more. That's the beauty of this. You have options. Okay. So I can't, do you have to? No. Should you? Probably. If your goal is to get to the end of the rainbow, to have X amount of dollars on the date that we say you're going to have X amount of dollars, then you need to follow the program. The program calls for you to repurpose the debt service you were making to continually build that debt snowball, which remember, maximization, accumulation, distribution. Once we get rid of our debt, we're in the accumulation phase. Okay. So if you want to pull back, that's fine. You can. You're not going to have as much money in the end. It's up to you.
Does the software allow you to, like, say at some point when you're in the accumulation phase, like, hey, I only want to do that this much? Will it actually forecast that or no?
So in order for the illustration software that I use to do that, I actually have to schedule that on the illustration software from the carrier. So you have to know how to use both pieces. They don't talk to each other well. Okay.
Cool.
All right. Lisa.
That was my question. It was like, okay. Do y'all have software to help with all this? Or is it something that you've got to come up with on your own?
No, there's about 6 or 7 pieces of software out there. Some of them are SaaS models where you pay a monthly fee. Some of them are purchase models where you pay one time and then you have to pay whenever you want to update it. You pay an update fee. Some of them are done in conjunction with a carrier potentially. So there's about 6 or 7 that I know of. I have my favorite, which is the one that I used to do this demonstration tonight.
Which is what?
We can talk about that offline. I don't want to advertise for anybody.
Okay.
Okay. But I can tell you right now that, Symmetry has its own. Symmetry has debt-free life software that once you become certified, you can use the DFL software from Symmetry for fee. But the nice thing about Symmetry's piece is that it's a month-to-month contract. So you don't, like most of the carriers, the ones that I have seen, they're going to make you sign up on a contract for a year and a half, 2 years. So you're locked in. Symmetry's it's blank per month, and you want to cancel at any time, you cancel at any time.
Right. Kind of makes it easier for them to cancel it.
Yeah. They're not trying to make money off you. This software they created is very expensive. So and it works. It's good stuff. All right. I see one more hand up.
Thank you.
Yep. Thanks, Lisa. Faith Deal.
Hello. Hi. I want to know if there is an age cap on enrollment for these programs.
So
like a maximum age.
Yes. So and it has to do with the term rider and the carrier. Okay. So in order for these programs to work at their most efficient, you have to have a term rider in there. That term rider creates more space for you to build cash. Okay. So if you can't have a term rider, then the efficiency of the program is going to be limited. And that age, depending on the carrier, is either going to be 70 or 75. Okay. But there's more pros and cons to it. It depends also on the carrier, because there's a cost of insurance component. And as you get older, obviously the cost of insurance is higher. And if you're with one of the carriers that offers an extended age, up to age 75, that particular carrier has a $50,000 minimum whole life purchase, which means the program is going to be very expensive to begin with before it even starts building cash. So you got some things you got to weigh out here. But 75 is the max age that's out there for a term rider. And for the other two primary carriers that we use, it's age 70. All right.
Okay, great.
Right.
Thank you.
All right, Mr. Peterson, and then we're gonna. I don't see anybody else. We'll get to bug Mr. Mark.
So can you, with the the DFL, the Infinite Bank, you can have multiple different ones. Is that correct?
To the limit of the life insurance amount that the client could be approved for.
Okay. So with that being said, can you have one for, like, say you have one for the Infinite Bank, to pay off those debts to DFL, but at that point, can you have another one where at that point it's gaining that cash value and you can use it for, like, making purchases on real estate and things like that, combat aspect of using it as.
So let me answer this. The reason why you have various banks is irrelevant. You can do whatever you want to do with the bank. Okay. Whether you say, I want this bank's money to be designed to go do real estate purchases, and I want this one to go buy retail store purchases, and I want this one to go buy physical gold with. It doesn't matter what you're using the money for, because once the money leaves the carrier, they don't care. It's your money. You do what you want to do with it, right? So again, the only restriction on whether you can have one bank or two banks or five banks is the amount of life insurance that person is eligible for. And traditionally, it's going to be a number around 15 times their income.
Cool. Thank you.
Okay. All right. Let's get Mr.
I'm sorry. It's Lisa again.
Hi, Lisa again.
I don't want to make this public, but I mean, I don't know how we'll get to talk to you privately. I don't have a 401k.
Great. You're in great shape. It's a bad idea to be in a 401k right now.
I don't have a savings for my retirement, is what I'm saying.
You have a savings
account?
Is it
too late for me to start saving?
I don't know your age.
I'm 58.
Nope, definitely not too late. If you were 75, I'd say it's too late. But you're good to go, right? One caveat about what I just said. Just because the insured is 75 or 76, or I did one on an 86-year-old, it doesn't mean they have to be the insured. They can be the owner of the bank. They could insure, like in the one that I did last year, they could insure their 55-year-old son, or they could insure their 33-year-old grandchild, or they could insure their 18-year-old great-grandchild. The only issue there is there has to be an insurable interest. So using these private banks, and that is an example of what I just said, this is a great way to create generational wealth. Let's say Journey Peterson is my son, okay? And I'm 30 years older and my health is not good and I can't get insured because it's going to be too expensive for me. I would be the owner of the policy. I would be the payor on the policy. I'd be the private banker on the policy. I'd be the person that gets to use the money in the program until I die. And then when I die, because I used Journey's life as the insured, the policy would transfer to Journey. And then Journey's got this built-in thing that's got all this cash that I've been throwing in there for years as a retirement vehicle. So yes, it's not too late for you. Okay? That help? All right. Dr. Creighton.